All right, we can move over to the single family home investment climate. Now we've covered commercial real estate, and we've covered the kind of the a little bit of the cloud of uncertainty, less confident that maybe you would expect, even though they're not, in the doldrums. It's not totally doomsday for commercial real estate investment at all, but it's not as good as it could be. And I think that we're seeing a little bit of taste of that, at least according to Realtor.com, in the single family home market, where it says that investors are selling a record share of homes to cut their losses. They're saying, especially in these 5 states, I'm not as confident in their way they're breaking down the regionality of this. I'm more interested in how they're tracing this trend of the home investors. Spencer, I thought that the investors are buying up all the homes and making everyone else live in them and renting them. I thought that that's what they were doing.
Well, maybe they did.
Well, right now
they already did that, I guess.
Yeah, they already did that. Now
they did it. Yeah. I mean, some investors bought homes, yes, and now they are selling them. I mean, it's certainly a non-true statement that. Like some say that investors have come in and bought all of the homes or the vast majority of homes. There's really no data or science to suggest that. Did they have investors increase their allocation to single family assets? Yeah, sure. That really happened after the great financial crisis.
Mm-hmm.
And they've done it a little bit in recent years as well, but still, owner occupants are the vast majority of the purchasers of single family homes. And again, we could go into a whole conversation of even, whether it's even a good or bad thing that it's investors versus occupants that are buying homes versus renting. But the reality is, man, whether it's investors, whether it's single family occupants,
mm-hmm.
not a big surprise. Who can afford the mortgage? Who can afford the interest rate? Who is excited to, if they do currently own a home, to trade out their 3%? And if you're an investor, it's not as exactly. You thought that you were going to be flipping this house. A lot of investors are in it for a short time horizon, and then that's very short. We're talking less than a year. 3 years is long to a lot of investors.
Mm-hmm.
And so, if you bought a lot of homes in 2021, 2022, when rates were near zero, maybe you've got a little bit of appreciation. You can get out, you didn't get the big pop that you thought, but it's time to get out and cycle out. And so there's a lot of inventory hitting the market, and that's not the type of seller who cares about, I'm going to be paying a higher interest rate because I'm going to be buying a place to live.
Mm-hmm.
These investors, they're not living in the house. They can sell it. They don't care as long as there's a buyer on the other end. The problem that we're seeing is there aren't that many buyers. For obvious reasons, it's because of interest rates and uncertainty, but especially interest rates.
Yep. I agree. It says in 2024, just under 11% of all homes sold in the U.S. came from real estate investors, the highest share in the data's history going back to 2001. Investor home sales ticked up 5.2%, outpacing the increase in investor buyer activity. So that's awkwardly worded. What this says is that more investors were selling their homes than were buying them. Investor home sales. So investors were selling their homes more than they were buying their homes. They're dumping them. And this was in 2024. And I don't think things have changed in 2025. This is another thing too that we talked about in the early years. I like to think I'm getting nostalgic for the early years of a great
early days.
Was we looked at single family home investors and how it tracked with home values and the trends and basically I was looking for, all right, the savvy home investor where the home investment picks up when values are low and then they dump them when it's high. When in fact, it seemed like if you take it all by the trend, the share of home investors peaks when the values are high and they really go down when the values are low. It's almost like they're dummies, but they're getting excited when I'm sure that they have different exits and stuff, but it is not exactly, they are not moving the prices at all. And if they are following the prices, they're following it in a way that's like that's not to the detriment. If anything, they're kind of losing money on these things when the prices are low.
There's an old story. I remember my dad telling me this about his first day in business school, and I think it's one of the last classes he had business school that he actually attended. But he said his professor said on the first day, he said, at the end of class, he said, if you show up, the next class, I'm going to show you the secret how to make $1,000,000. And they all showed up, and the secret is it's really simple how to make money. You buy low and you sell high. That's it. But if it was that easy, everyone would just do that thing. But
Yeah.
it's not very clear when things are low or when things are high. And so it's over exuberance. It's classic investor psychology. It's fear and it's greed at play here. When prices are high, you see people making money. A lot of that's happened in the past. You want to get in on that. Fear of missing out, FOMO kicks in. You jump in, you buy it something because people think that things are never going to stop, and because there's whole industries that are banking on the gravy train continuing to go. Let's just keep this thing rolling as far as we can take it. And then when it's the time to buy, everyone is saying no, there's no money available to even go and buy the things, just like we're seeing right now. And again, this is why I'm excited. You don't see a lot of equity because people are scared right now. And when people are that scared, it's a great time to get in. It's the classic, be greedy when people are fearful,
Totally.
be fearful when people are greedy. It's kind of a classic example. Now, again, we're coming back to, there's a lot of nuance, right? I mean, not all of these regions, not all of these markets are the same. Certain markets had a ton of private investors that came in. Some of those markets have held up well, some haven't. If you're looking at Florida as an example for the entire housing market, you're going to make a big mistake because you've got a lot of other factors in Florida or in Texas or in the Gulf states than you do in the East Coast, West Coast, Midwest. So there's a lot of nuance. Sure, there can be some broad trends like interest rates, like capital markets, like tariffs, that type of stuff. But man, it's time to be tactical. It's time to understand exactly your strategy and focus on that and not paint with a too broad of a brush, which unfortunately, when you're putting a report together, it's hard to focus on, one market. And so you're focusing on like that Avison Young piece. Granted, the reason why he selected those markets is because that's where a lot of those readers are, and that's where a lot of his base is. And those are institutional investment markets. There's money in Silicon Valley, there's money in Chicago, there's money in Los Angeles. That's why it's not necessarily have anything to do with which markets are going to be the ones that we should talk about or which markets are going to have the best opportunities. It's literally, we want to get clicks for our reports, so we'll select the markets where our readers are in. Or that they might sort of be interested in.
A lot of this does reflect the kind of dominant investment sentiment, and the way to make a good investment is not necessarily to go with the flow. You have to figure out where the flow is going to go, and that's sometimes that means going out on a limb, but not necessarily. I think it just means kind of uncovering something that people haven't noticed, but that's my own personal thing.